Is the stock market going to crash in 2021? Stay tuned, and in this video, I'm going to try to explain why I think the stock market crash might be over, but exactly what warning signs and early clues I'll be watching for to know there might be more downside. I think that it is very important and relevant for us to not only be prepared for the dip, but understand what it means to actually prepare a plan. And if you're interested in learning more about that, just keep watching the video, and you even have a chance to win $1,000 for preparing a plan if you stay tuned until the end of the video as I go through that. If you're new to this channel, my name is Justin, and every weekend we try to go through and understand where the stock market's going to be going for the week ahead, how we can be prepared, and most importantly, how we can have an edge. So as we jump into this weekend's video, again, what I would really appreciate is your support. This channel is almost new and seems like a small gesture, but smashing that thumbs up really goes a long way to support me, support the channel, and make sure we get to a bigger audience and support more people. So as we're looking here, it appears like the stock market crash might be over. I've been showing this specific chart here for the last couple of weeks, and as we look here, it kind of looks like it might be over. We have some warning signs. There's always warning signs though. The market is currently in a low volume melt higher. So quickly looking at the chart here, we can note that it looks like the stock market crash is over. I am going to be away for this next week. So the reason why this video is particularly important is because you're going to understand exactly how I am being prepared to be away from the screen with the potential for a drop, which means that I have to be confident in my analysis, understand exactly what I'm going to be looking for and how I know I'm going to be wrong. So the last time we checked in, we were looking back over here where we had this period over here where we were forming that inverse head and shoulders. That was the last time I really reviewed this chart in depth. In this period right here, we can clearly see that we formed an inverse head and shoulders and we pumped to new all-time highs. Every time the S&P touches the 50-day moving average, we pretty much bounce. So bounce, bounce, bounce. No surprise, we bounced again. So now that we've completed this part of the pattern, we're looking over to the latest part here. And what we can note is that this specific pattern is a cup and handle. We can see that we crashed down to the 50 DMA and we bounced right back off. And inside of here, we're forming an extension. So we have a cup and handle with a handle and a pass. That's the easiest way for us to understand what's going on here. We're in a low volume liquidity driven rally, and that's pretty much it. So trying to aim for a shorter video this weekend, and as a reminder, we do have a show schedule to go through. So again, yeah, if you guys wouldn't mind smashing that thumbs up, that'd be greatly appreciated. We're going to go through and try to figure out whether or not the stock market crash has been avoided, how we can prepare, and your chance to win $1,000. I'll go through this a little bit later in the show. There is a $1.5 billion straddle that was put on, and straddle and spread, and that is for 2023. So someone is betting we're going to be making a move dramatically higher or dramatically lower. We also have an update from Goldman Sachs where they're looking for 3,700 on SPX going into the end of the year and 3,900 going into the end of next year. There's an acronym going around the last couple of weeks. It's called TINA. There is no alternative. So the market is melting higher because there is not many other places we can put our money and make a return. We also know that the Eastern country is cracking down and locking down, so money has to flow somewhere. It's not going to sit in a savings account. So the US market appears to be the most attractive and where money is flowing. Lastly, the two things we want to keep in mind here is that if we are in a liquidity-driven rally, we have to pay attention to the Fed. The Fed is going to have Jackson Hole coming up at the end of the month, and then we got our September meeting where they're going to have to provide economic projections and tell us where the market's going to be going next. So I apologize for the clickbait of the title a little bit, but I think that just getting people prepared for the potential is the most important thing here. So I'm going to start jumping straight in and let's go through. So where I actually want to start is going back to the levels that we had from last weekend. So if you're wondering some of the things that you missed by only watching the public video, there's two parts to these videos. There's a public one and then a private one. In the private video, I go through and actually not just explain how I'm thinking the market's going to move, but key levels of support and resistance, and exactly how we can strategize to get prepared for the week to make money. Looking here, what we can note is that I was 7 out of 10 bear this week. So again, the reason for that is because I was looking at the risk reward. I thought that preparing for the dip this week was particularly important because we had a seasonality chart which was flashing us a massive warning. Ended up being a void. So the reason why this is important is because the last time that I have put a bearish bearish label on one of these weekend deep dives is going back to May. So since May and June, I think actually. So that's when we had the last dip. So we're due for a dip. Dips are healthy, as a reminder. If the stock market just continues to go higher on a relentless bid, it's not that it's not possible. It's just not as sustainable. So what I want to just point out here really fast is the chart that I had from before. And this will just quickly explain, again, why I think that we got to be prepared. This pattern here is the one that I am specifically looking at. So in the first few minutes here, I'm just going to walk through a quick little example of why I think the stock market crash might be coming. The pattern is valid here. We note that we have an inverse head and shoulders with the potential for a massive drop here in August, testing to an IHS and basically a neckline here. So that would correspond with 423, 428. Those are significant areas on my monthly chart. I'll show you those here really fast. So as we jump over on the monthly chart, what we can identify is that 422 in the month of August would be a higher low. We're only halfway through the month. So 421.97 is our July low. Anything above that would be a monthly higher low. So I'm looking for potentially down to 422 to 428. The odds of this happening look lower, but it does not mean it is not possible. It just does not really look very probable right now. So that's where these areas come from. They're very significant to me, 422 and 428. And the pattern here is getting invalidated. So what we want to keep in mind is that at some point we will have a dip. Maybe not a crash, but we will dip. And if the strongest rally of the year is coming between September and the end of the year, or the Santa Claus rally, that is how we can get to Goldman Sachs's target of 4,700 by the end of the year, and then 4,900 by the end of next year. However, if we're already going straight up with the biggest move is going to be harder without at least shaking the tree and testing the bulls and the bears. So whether the dip happens in August or September, I don't know, but I'm prepared. I'm prepared for now, I'm prepared for later. So as we look at the pattern here, again, we can see that clearly this would be a pretty big dip. That's nearly 200 points on SPX or 20 points on SPY. We can jump over here to the SPX chart and actually see how the chart is looking now. So here we go. What we actually did was formed higher lows and bounced off that area. So what we're going to need to see to confirm that this pattern is bearish is what I want to walk through here. So we pretty much have to fall back below on a daily closing basis, back below roughly 442 on SPX. I'm using the level of roughly 440 to 441 on SPY. And as long as we keep forming daily higher lows, the probability we're going to slip lower is getting decreased. However, that is the threshold. So number one, as long as we keep putting in daily higher lows, we look fine. Daily higher lows would be a warning. Falling below on a daily closing basis below 440 would be the start of the confirmation, and confirming it by getting a daily close back below 438.6 or flipping red on the monthly candle. That's what I'm looking for here. That's the easiest way to explain this. So again, until this happens, it is possible. It's not forming yet. So again, we got to take it with a grain of salt, but we got to keep it in the back of our minds that if we lose 441, 440, and 438.5, we have to be prepared for up to 20 points more of downside. And as we sit here, I have an upside target on SPY of roughly 450. I'll walk you through how we can get there as well. I have things a lot better prepared this weekend, so hopefully it's going to be a little bit easier for people to follow along. And there we go. Let's jump to our card from this week. So there we go. Again, support and resistance. I was looking at 444, 442.5, 445, and 447.5. We pretty much closed out on Friday here at 445. We got basically halfway between 445 and 447.5. So again, the levels of resistance have been fairly accurate, and that's what we're watching for. So as we look forward to this next week, which is going to be August 16th, again, quickly here, it appears the stock market crash has at least been voided for now. There is a $1.5 billion straddle. So what I'm actually going to start going through now is going to be bringing you over into our world in Blaze Capital, which is Slack. So looking over to here, you're going to see all my notes that are inside of here. And the first thing we're going to look at here, let me just make sure I'm following the schedule here because I got a few threads. $1.5 billion straddle. So looking over here, what this means is that If we delete everything off here temporarily and we look at what that would mean, so we're looking out to 2023 because this is a, so just give me a second here, bear with me as I get this prepared. All right, these candles look a little bit bullish, right? They look a little bit bull. And because of the timing of those new upgrades, we now have targets for 5,000 and basically 4,900 going into the end of next year. So the reason why these are significant is because we look at the premium attached to them. So over here, we note that we got 4,000 and 4,000. This is a straddle going out to the end of 2023. What they've paid in premium is $700, roughly 360, which is roughly 1,000, which means that they are going to remain unprofitable if we remain inside a range of 3,000 to 5,000, or if we just do something like this between now and 2023. Unless we break above this area, or we fall below this area at 5,000 and 3,000, that $1.5 billion goes poof. It gets evaporated. The people who sold these contracts collect the premium, 1.5 billion. So the reason why this is notable is because it's the first time I've seen a major straddle put on the market for a while. These people are expecting a massive move. They're expecting a massive move of 1,000 points. So a 4,000 straddle going out to 2023 is important. So we got nearly $1 billion here on the 4,000 call. We got about 354 million here on the 4,000 put. And then we also have a put spread for 4,000 and 3,000. So they're buying about $190 million of insurance that if we do start pushing lower, they want to have that insurance. So we've got a bullish, we got a straddle and we got a put spread for $1.5 billion. What this basically signifies to me is that someone is ready for a massive move. Which way? They probably don't particularly care because they've got the straddle. That means that all we have to do is move significantly off that area, off the 4,000 area. And as we're really closer at about 4,500, again, 50 points higher, 50 points lower. I don't know. That's the most important thing for me right here. All right. So that explains this target here. Now I'm going to jump through to the Goldman Sachs target, and then we're going to go back to Slack and finish off the story. So looking on time here, how long are we into the video? About 12 minutes in. That's not so bad. So looking here, again, Goldman Sachs is the bank that I have the most respect for because they run Wall Street, right? They're in charge. Whatever they say basically goes. So when they give us a target here of 4,700, we reviewed this in a previous weekend deep dive where they laid out their base case, their bull case, and their bear case. So this is pretty much just an update from that. We also had a previous article where we talked about $500 billion coming into the market going into the end of the year. So again, here's that first one again. I just want to walk through these like really fast. This is going back to June 21st. The bull market will get a $500 billion cash injection by year end, Goldman says. Goldman target. I'm not going to be able to find it. Anyway, I don't have it prepared. I'm sorry. But going back to here, what this basically means to me is that we've now had what they wanted. Low yields, high corporate earnings beats. And if we quickly read here, again, David Kostin is the head analyst over here. So they're now one of the biggest bulls on Wall Street with a target of 4,700 by the end of the year, raised from their earlier prediction of 4,300. What I want to jump down to here is actually the commentary from David Kostin. The combination of higher than expected S&P 500 earnings and lower than expected interest rates drive our upgraded price targets, the Goldman strategist said. Relative to consensus, we expect stronger revenue growth and more pre-tax profit margin expansion as firms successfully manage costs and the high margin tech companies become a large share of the index. So again, large share of the index, meaning the tech stocks are going to be rallying. If we jump down to here as well, again, the Goldman strategists also increased their end of 2022 S&P 500 target to 4,900 from 4,600. That signals more limited upside for the benchmark with a return of about 4.3 for the year. The increase in earnings is also expected to slow down next year with 2% annual EPS growth, they said. All that means is that they think we're going to go up and then we're going to flatten out. So they think that we're going to do something like this. And again, that level of 4,900 is significant because that would mean that that $1.5 billion gets bingo, basically nothing. They would have to have a big push in 2023 for continuation. So if Goldman's right, we're likely going to do something like this. Up, up more and then stall out. We don't have their 2023 projection yet, so that big $1.5 billion straddle is going to need us to keep doing this. If we go all the way up and then we stall out, that money gets collected. So that's why it's important here, because that 5,000 target is very big. It's a very round number. The other thing to remind ourselves is that look at our low all the way back to here. It's at roughly 2174. Our low over here, roughly 2361. So we went into a channel lower here. And if we go to roughly 4,900 and then have our big stock market crash by 50%, which is probably going to be coming in 2023 or 2024, that would take us to a higher low. So the higher we go up, when the eventual stock market crash comes, we're going to be putting down a higher level here. So again, if we push to say like 5,000-ish, we'd be dropping down by about half, and that would take us to here. When the market really crashes, it crashes by about 50%. And the same recipe that we're seeing on previous crashes is setting up now. There's also even a very interesting stat, which was talking about, let me just get all my lines back here. There we go. The DAX. So quickly touching in on the DAX. The DAX market is closed consecutively higher for the last 10 days. So you note here I have two red bars. That's just because they closed lower than the opening price, but they closed higher than the previous session. So what that means is that we've closed higher for 10 consecutive days. The last time that happened for the DAX was in 1999. 1999 was not the top. It was the start of the top. Then we had the oversized move higher and then the eventual drop. So maybe that's what we're doing here. We're definitely, I believe, in the later part of the cycle, but we're not ready to go down yet. There is no alternative. If there's no alternative, people don't want to stop making money, right? People don't want to stop making money. So if the housing market is now starting to settle and we know that other markets are not as favorable, meaning that you don't know if your money is going to still be there tomorrow or if there's going to be a fresh crackdown, well, good old USA is always there, always steady, always reliable. So I think that money is going to continue to flow into the US. And until we hear otherwise from Mr. Jay Powell, transitory is the name of the game. If we heard from El Arian this week again. El Arian is a pretty big guy when it comes to the stock market, Mohammed El Arian, and he's calling for that the stock market faces some major headwinds if the Fed is caught off guard. The market has been conditioned to believe and trade based on the transitory inflation. If that ends up not being the case, the market is likely due for a rude awakening and a crash. Again, potential. That's all it is right now, is potential. So we're going to be looking at the Jackson Hole and the September FOMC meeting where they're going to be providing economic projections. That's really important here. So we got through this one, and then again, how to prepare for the chance to win $1,000. We'll go through that at the very end of the video. All right, let's jump over here to Slack and let's get going. So now actually one more thing I want to walk through here is just going to be, do I want to do this in order? Yeah, I'm going to do everything in order here. So $1.51 billion straddle. Haven't seen those put on in about a month now. Now we look out here to next week for the options chain, and we're going to start going through our normal calendar here. So actually what I'm going to do is just do this here. So I'm just going to jump over to the SPY, which we are going to review in the later part of the next thread. So just quickly looking here, I'm seeing the potential for us to squeeze up the 450 in the Friday. Right here on monthly OPEX, which is going to be on Friday, monthly options expiry, we got a target right here at 450 on August 20th. Oh, okay. So if we're going to get there, is there any evidence that means that we're likely going to get there? Well, the uptrend's up. If we hold this uptrend, we will be at 450 on Friday. Okay, cool. 450 on Friday. Whoop! Right? Halfway to 500. Let's go. So into monthly OPEX of next week, we've got 445 call open interest. On Wednesday, we got 450 call open interest. And then into Friday, we got 440 straddle and a 450 straddle. If you're not sure what this means, just bear with us for about 30 more seconds and we'll jump forward to the next section here. So all this means is that this is unusual. We normally don't have 100,000 contracts that are in open interest for a Monday. This is particularly notable. That's a lot. That's 10 million shares equivalent. We also note here that everyone's pretty much buying out of the money. So from 445 up to about 448 is where the activity is concentrated. And over here on the put side, there is open interest as well. So here 440 is the notable area, but again, starting at 446 all the way down to 442. But the main note here is just that open interest, whether or not they're going to get their money back. Looking out to Wednesday, we're seeing bullish continuation. So we have that big fat number at 445 on Monday. We're looking right here at 450 going into Wednesday. 26,000, it's not huge, but it is notable. Again, roughly the same strikes are getting bought up as well. Looking out to Friday, which is going to be monthly OPEX, the reason why this one is particularly important is because there's more money expiring on this date than any other one for the month. Look over here. We've got huge amount of open interest. 112, 91,000. So over here we got a straddle. Straddle just means, again, that we're looking for a big move up, higher, lower. As of right now, this straddle is priced at about 630 and about 60 cents. What's the break even on that? 447. So we have to be at 447 for these guys to get their money back. Oh, so if they want their money back, oh, okay. So if they want their money back, we got to be at 447. Yeah, we got to be at 447. Looking up to here again, the 445 call, which is the most popular one with the most premium, 445 plus $2, we get that same 447. Same 447. So again, 447 kind of seems like a big threshold here. Once we look past that, we also note that there is the most volume here at 440 put and up here at 445 call. Last thing I'll point out is that we're seeing the same flow from Monday through to Friday. We're seeing continuation. And over here again, the numbers are a lot smaller. The premium is about $5. So again, about 460 plus about 30 cents, roughly $5, but they trimmed off about $1 in value here. So what does that mean? There is potential for us to push all the way up to 450 into Friday. The thing that is going to be particularly important is who is in control. We talk about maximum pain on the streams at lunch often. And if we look here, 440 would be max pain. So if the option sellers are in control, they would want to walk it back down to 440 into Friday. If the option buyers are in control, they're going to want to walk it up past 447 or dump it down below 433 because they got to get a 7-point swing off this 440. And sitting up here at 445, we're basically asking for a 10-point drop for them to just get their money back. That seems like a lot, 12-point drop. I don't know. So it kind of seems like the upside is going to be where we're going to be going. Jumping forward to the next section here. The reason why this is important is because I'm seeing bullish continuation. So looking out to September monthly, which is going to be in 35 days, we note here that we got the straddle's not really there. It's not that, again, 28,000. Over here we got 111,000, twice the premium. So that number's huge. And looking over to here, we got 440 and 450. This is a spread. That's a call spread. What's also really notable to me is that when we look at 440, the premium on these is just over $10. Break even is 450. That's how we get to 450. So what we could do is advance to the 450 area as I have drawn with the pink line there and then pass. The other option is that we do a test. So what often happens is that we have to do multiple tests before we break through the area. So again, 1, 2, 3, break higher. So technically this would be our first test at 450. Maybe take 1 attempt, 2 attempt, and on the 3rd attempt finally break up. Oh, yeah. That's what I think could be happening here. So we're watching closely for that area, and 450 looks like the continuation going out to September. Next thing we're going to look at here are going to be the August indicators and ETFs. So again, if you want access to this, again, you can sign up for a 7-day free trial, which you can see over here in the bottom side and also in the links in the description to join us. QQQ. So again, looking here, we got a Friday apex at 386.5. Third test at this level. Is it ready to break up? So if the S&P is going to get dragged above 450, we're going to likely need to see the QQQ pull higher. As Goldman Sachs noted, we should see an overweighting into tech stocks going into here again. 1, 2, the third test. It should break higher if we're bullish. If we're bullish, it should break higher. Looking at XLF, we got a cup and handle. We have the third attempt at 38.5 and a break up, and it is currently back testing. What does that mean? Well, look here. 1, 2, 3, break higher. 1, 2, 3, broke higher, and now back testing. If this 38.5 area holds, looks good to me. It would support the S&P. So XLV. 3 tests and a break up. This is pretty much our template that we're looking at for the 2 previous charts. So over here, we can note that we have Right, looking a little bit closer here, right? 1, 2, 3, pass. 3 tests and a pass, right? The W. It's what we always look for. DIA or the Dow Jones. Similar 3 tests. It's not as perfect, and then a break up. So we look here, and we got 1, 2, 3, and a pass. Nice. Looks bullish to me too. IWM. Many tests at 230, and it can't pass. Range bound, 50 DMA versus 200 DMA, and the chart looks sloppy. So what this means is that tech is pulling ahead. The Russell has outperformed dramatically year to date. However, a lot of meme stocks and, again, frankly, junk stocks are included in the Russell. So it looks like the meme complex is finally starting to soften here. So 1, 2, 3, 4, 5 tests and back below the 50. Still doing okay. Chart just looks sloppy. So the Russell is not ready to lead right now. The VIX, or the volatility index, is also flashing us a signal here. We got a solid funnel lower, and we have an inverse head and shoulders at roughly a 15 neckline, which just means that the VIX is currently pointing down, so the path of least resistance is to continue to point down. I'm noticing an inverse head and shoulders pattern here, head, shoulder, shoulder. So this 15.2 area is a previous base and a threshold for me. If we lose that, we're probably pushing back down to 10. Anything inside the teens is considered low volatility for the market. At 15, we're in the low teens right now. DXY, or the dollar index, we can look here and see that we have a large W that is still intact. We have a short-term cup and handle, which is yellow, and we have an inverse head and shoulders that is the last month with a 92.5, inverse head and shoulders in the last month with a W, 92.5 neckline. So over here we got a massive W. Over here with the the yellow line, we got a cup and handle. And then inside of here, we have that inverse head and shoulders. So I don't know which way this thing is going to go. But as I noted here, DXY was down by 0.51 on Monday. The S&P only closed up by about 0.18. There's about 0.3 missing here. I think they suppressed the S&P to not pay out those 447 calls. If it's true, we should see a snapback on SPY into Monday. Why? Because these things are inversely correlated. It's that simple. Looking over here at Bitcoin, it is claimed that 200 DMA. Every backtest is passing. Now we got roughly 46,700 as a key area. So as we're looking over to here, what we're going to notice just that we got these 2 areas. We got support, resistance, and again, hit the level, back off. 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 If it can hold this area, it's probably going to be pushing to 50,000. ETH, nice bull volume building up. Means it's actually getting more bullish than Bitcoin. W is basically complete though with a 3380 target. So looking over to here, right, we got our massive W. So that would be the first target here. Second target would be the all-time high. So we note the previous area here, which is where we dove down, and over here we're actually forming a base and passing. We're backtesting and passing. Increasing bull volume, usually a bull sign. Finally, over here we got the TNX, or the 10-year treasury note. So looking over here, we got a let me look at the notes here. So Goldman Sachs is calling for 1.6 by the end of the year, and it happens to correspond with completing a W pattern. We're looking at a battle between the 50 and 200-day moving average. So looking over here again, we got that W forming, and if it completes, we should be back up closer to that 1.6 area, roughly into the end of the year. If we lose this, again, it's a W, also a head and shoulders. So if we lose this 200 DMA at roughly 1.29, we're probably going to start pushing lower, maybe to 1.25, maybe back down here to 1.1. So that's the most important thing for me. And again, understanding that TNX is inversely correlated to tech stocks. These lines point down, tech should point up. These lines point up, tech stocks should point down. Finally, looking at the NYSE, it has had 4 tests. So 1, 2, 3, 4, and pass, which means the average stock inside the NYSE, or 2,000 stocks, are on average going higher. Finally, we got the DAX, which is also breaking bullish. 1, 2, 3, 1, 2, 3, 1, 2, 3. There we go. I'm already clocking in at about 30 minutes here, so I'm going to start going a little bit faster. I think I'm pretty much done though. So I went through the S&P 500 summary. Let's have a quick look at the heat map here. So what's actually been happening here in the last month, in the last 1 week? Right, FinTech not doing so great. Amazon clearly red, and then a lot of mixed, right? Lots of mixed stuff here. Bright green, bright red, and then pockets of like muted green and then muted red. So we're seeing rotation. Looking at the last week, pretty much the same, right? Red, pretty much playing through here. So semiconductors a little bit red here. Woof. I don't know exactly what's going to happen, but I am noticing that we're seeing rotation happening. So I think what I laid out earlier is pretty much being confirmed here. Finally, oh, I got to get through the rest of these threads here. That's what I got to finish off and do. I already did all this stuff. So notable events in the calendar. So looking over to here, here's the economic calendar for next week. So if we're looking for data points which could support or invalidate our thesis, over here we're looking for GDP out of Japan on Monday. This will be a preliminary number for Q2, and that's going to be quarter over quarter, not year over year. We're also going to be getting industrial production out of China, which is important. That's going to hit the tape before we open up on Monday. So again, that big call activity at 445 might be some speculation that we're going to get a move higher starting in Asia. You know the big star right here? That is for Mr. Jerome Powell. So Jerome Powell is going to be speaking, giving a town hall on Tuesday at about 1:30. We also got core retail sales coming in pre-market on Tuesday, so pay attention for that. FOMC minutes coming out at 2 o'clock on Wednesday. That is going to matter. Finally, we got the PMI, or Philadelphia Manufacturing Index, coming in on Thursday, also including initial jobless claims. So we got more data this week, significantly more than last week. Again, we talked about the levels here from the S&P. And then finally, for Jackson Hole, we're looking for August 26 to 28. Now we have the S&P 500 analysis. So what I'm laying out here, I'm actually not going to go through the individual charts. I'm going to go through everything here in this thread because I tried to explain the story ahead of time so I can review it instead of actually doing the analysis on the fly. So over here we got that 450 daily apex going into August 20th. Failing to break up over 450 or our first attempt would likely lead to a 440 test, 440 area. So again, if we melt up into here and we don't break up, we're likely going to see that move back down. And we note that the September straddle is likely the clue here. We're seeing a 440, 450 spread, not a straddle. So if we push up into here and then don't pass, I have a suspicion we're going to come back down into here and do that 1, 2, potentially 3 tests into the end of September, which also happens to correspond with our seasonality chart. Whether we get the move right here or into October, it doesn't really particularly matter, but that would pretty much confirm that we got 1, 2, 3 tests in the pass, or the W. To validate this pattern, we need to. So again, to validate, so if we're going to be bullish and we're going to avoid the stock market crash, we need this. We need to validate the bear pattern by getting a daily close. Let me go back here. Oops. A daily close below 440 as the threshold. So again, a daily close below 440, as we noted earlier, is going to be the warning. However, on the monthly chart, as I noted earlier briefly, a daily close under 438.5 would start to confirm the pattern because we're going to be flipping red on the monthly. And then the next true support for me is all the way down here, roughly 428. So again, we got to pay attention to that. Those levels also perfectly correspond with this here, 428, 422, as we noted earlier. On the SPX updated, so far the pattern is breaking up, as I noted earlier. So again, so far it's being invalidated. What we're looking for is the what if we're bullish, what if we're bearish, and what is most likely. Finally, here looking at the ES1, which is what we reviewed at the beginning of the video. Bullish pattern till proven otherwise. It's strong. All right. Again, inverse head and shoulders, cup and handle with a pass and a nice extension. Bullish. The weekly, so 452.5 is now going to be our weekly uptrend. If we keep pushing higher above 450, 452 is going to be the threshold here. Every time we throttle up and hit this upper trend line, if we don't pass and hold it, we usually start to fall back down to the lower part. Over here again, that corresponds with 436 going into the next week. On the daily chart, we notice the angle of ascent is starting to flatten out, which means we are melting up and not pumping up. The Friday uptrend test, the white one, is going to be landing at 446, and the Friday uptrend test, the pink one, is going to be landing at 440. This also happens to correspond with max pain going into Friday. So what all this means is that if the option sellers are in control, they're going to want to have this chart down here at 440 into Friday. They'll find a reason, they'll find an excuse to get it there. if the option buyers are in control, they're going to want to push this thing up closer to 450. What we also can remind ourselves is that there's been enough theta burn over time that they could have actually scraped and fixed these chains. I think that we're either going to be around 450 or 440 by Friday. That's my suspicion. I'm not super confident on that though. Why? I don't know who's in control. We're melting higher, so the bulls have to have it. I think that's pretty much it. We can now circle back here and have a look at, let me see if I can pull this up really fast here. Sorry. We actually have a prize giveaway here. So let's actually go to here and I'll show you how you can actually enter for a chance to win $1,000. You do have to be a member in our group, which means that you need to be inside of our Slack group. So jumping over to here, we're currently offering $1,000. So we have all these dip buy plans coming in now. So we're gonna look over to here, and this is how you have your chance to win that $1,000. So how can you win $1,000? Just keep watching here and I'll show you really fast. So again, August and September dip buy plan. So what I'm trying to do is to encourage people to be prepared for the downside, whether or not it happens. So here we got a $500 cash prize if we got less than 10 entries, a $1,000 cash prize if we get more than 10 entries. All you have to do is share your current plan for your current portfolio, share your plan for prepping for the dip, share your shopping list. Please be as detailed as possible. Be specific as you can, and just start a thread to get that done. We have a deadline of the 17th to submit your plan. And then we also have the voting ending on the 20th. The reason why we're doing these dates is because I want everyone to be prepared going into the monthly OPEX. So the way that you can join us is by clicking on the link in the description and just joining us for a 7-day free trial. So what that means is that you could actually get a free 1-week pass while I will be away this week. I'll be on holidays this week. So you'll get a 7-day free trial. And during that 7-day free trial, you could enter and actually win $1,000. So if that sounds good to you, again, just click on the link in the description and maybe we can have that show up at the top of the screen here too. So thank you again for watching. I very much appreciate your support and I look forward to seeing you on the next weekend deep dive. Thank you very much.